So here we go with basis again. So basis, the corporation has basis in its assets, just like any other business does. So they purchase a building, they depreciate it, there are adjustments to the basis up and down for each of the assets. So that works the same, but the basis to owners is related to, it doesn't adjust as often as it does for the owners of partnerships. Okay, you don't have this constant fluctuation, but there are two issues. So the basis in the ownership of the interest, so the stock, because whenever you purchase part of a corporation, you are purchasing stock in that corporation, and the basis to the corporation of property that's been exchanged for the ownership interest. When a C or S corporation is formed, individuals will purchase or otherwise acquire stock in the entity. So I may purchase it with cash. I may contribute property to it. Generally speaking, I'm trying to remember what the service is. We'll get to that part here. It's in effect, it's an exchange of cash or property for stock. It can be a taxable transaction. So remember, with a partnership, when we do that exchange, it's not necessarily a taxable transaction. It's only under very limited circumstances where any taxable event actually took place. But with a corporation, there are greater opportunities for it to be a taxable transaction. If the shareholders who are forming the corporation end up controlling 80% or more of the corporation immediately after the exchange, then the exchange is generally tax-free. So all of those owners together control 80% or more. So here we've got an example. Marty and Sarah, they're forming Boone Company. Marty transfers $1,000 cash in exchange for 100 shares of stock. Sarah transfers a bond with a fair market value of $100 with a basis of $800 for 100 shares. They're the only two shareholders because they control 80% or more. After the exchange, that transaction is tax-free. So even if that 80% rule is met, though, there may be a couple of instances when gain does have to be recognized. So when the individual transfers property subject to a liability, so again, this is where you have some sort of debt against that asset. So you transfer a building, but you've got a mortgage of $100,000 on that building. And the relief of the liability is greater than the transferor's basis in the property, then the gain is equal to the excess of liability over basis. So if we've got transfer a building, it has a mortgage of $100,000 that now I'm not going to be responsible for. The basis in the building is $80,000. Now I've got, because I've received relief of that $100,000, but I've been relieved of an asset that's worth $80,000, right? I got a $20,000 gain because I'm economically better off by $20,000 in that exchange. The gain is equal to the excess of the liability over basis. Another example, Gina transfers an apartment building to GGG Company in exchange for all of the stock in the company. The building has a basis of $100,000. Fair market value is $500,000 and debt of $300,000. All right, so, and again, remember the basis is that's not necessarily the fair market value, right? She's had the building, she's probably depreciated it, so the building is now the basis is now at $100,000, but the fair market value of it is $500,000. And with the $300,000, she probably borrowed against that increase in equity on that building. Even though she controls more than 80% of the company after the exchange, in this case, the transaction is taxable because she has debt relief in excess of basis. She has a gain of $200,000 because the debt relief was $300,000, the building basis was $100,000. Okay, she is economically better off in that case, although she did have a fair market value of $500,000. but she's gonna avoid having to pay for any gain on that increase in value. Second case, individual who contributes cash or property and receives in return stock plus other cash or property. That's called boot. So the taxable gain is going to be the lower of either the fair market value of the property that was received or the realized gain, which would be the fair market value of the property contributed minus the tax basis of the property. So here's an example of that. Ernie gets all the stock of EBU Company in exchange for contributing a machine with a basis of $15,000, fair market value $25,000. He also receives $3,000 of cash from the company. So they're giving him stock and they're giving him cash. The gain on the transfer is $10,000. So that's the difference between the basis and the fair market value of the machine. So the basis of $15,000 and the fair market value of the machine. He has to report $3,000, which is the lower of the gain or the cash received. So you would calculate the gain first and then look at the cash received, whichever is less of those two, that's what would be a gain. Okay? But then that attaches to any fair market value as well. So corporate entity, the basis of the cash or property received is equal to the basis in the hands of the shareholder. So just like with the partnership, that basis is going to transfer over, plus any gain that was recognized by the shareholder. So if the shareholder had to recognize a gain on that transfer, then that basis gets increased to the company. Basis in the stocks in the hands of the shareholder is equal to the basis the property contributed, plus any gain recognized, minus any boot received. Okay, so let's look at this. So we've got, is this the same? Ernie, Gina, are these both the, okay. So Marty, let's remind ourselves here, what did Marty do? Marty and Sarah are forming Boone Company. So Marty is transferring $100 cash in exchange for 100 shares of stock. So his basis is $1,000. He just paid for the stock. And the basis to the corporation is $1,000. It's $1,000 cash, right? That's easy enough to determine. Sarah. Remember, Sarah contributed a bond. It has a fair market value of $1,000, but the basis is $800, right? So in this case, her basis in the contribution is $800. The basis to the corporation is also $800. That transaction hasn't completed yet, right? That the fair market value of it is currently $1,000, but we're going to use the basis. Now we'll look at Gina. Remember, she transferred the apartment building, had a basis of $100,000, fair market value of $500,000, and then they assumed $300,000 of debt. So she has to report a $200,000 gain. Her basis is going to be 0 in this case. Let's see here. Taxable gain, lower market value. So they get 0. Fair market value is $500,000 because she's being relieved of the debt of $300,000. Basis is $100,000. So there's $200,000 that would be gained, but then there's also, I'm trying to think how they calculated this. So she's got a gain, but she also has debt relief, and they zero each other out in that case. So that's why her stock basis is now 0. And then the basis to the corporation, because she had to recognize that $200,000 gain, that gets attached to the $100,000 original basis of the property. So now the basis to the corporation is $300,000. Ernie, so he's reporting a $3,000 gain. He's contributing the basis basis of 15,000, so that's gonna be his gain. Whoops. But that $3,000 gets attached to the 15 as the basis to the corporation. Okay, so basis in his stock, basis to the corporation of that asset. So they may have, shareholders may have to recognize a gain, but they do not recognize any loss on the formation of a corporation. If they provide services in exchange for stock, the individual will recognize ordinary income equal to the fair market value of the services. Ordinarily, then that would just be reported on a W-2. They become an employee of the business, okay? Let's see. Unless the C corporation stockholder increases or decreases their proportionate share of ownership, there is no adjustment to that basis over time, like we had with the partnership, where you're constantly fluctuating, right? All right. Questions? This is probably the hardest one here to figure out when there is a gain. All right. No questions? We'll continue.